Okay, so the analysis report we're looking at today covers that recent 1.55% drop in NVDA stock.
Mm-hmm.
And it argues this is really just a temporary dip, that the, quote, smart money is capitalizing on it because of strong fundamentals and, of course, the Blackwell cycle.
Right.
And what I like, right out of the gate, is the structure. It's so clear. It moves from that specific market event, the $180.93 close,
Yeah.
straight into the institutional logic. It uses hard numbers, the Q3 revenue, the net income, to really anchor the whole thing. The foundation is solid.
It really is. The data is compelling, but I think there are a few opportunities to really elevate it.
Absolutely. And the first one, I think, starts with the tone.
To elevate this from an engaging market commentary piece to a truly robust analysis report, the tone needs calibration to strengthen its credibility with sophisticated investors.
Let's talk about that. When I look at the language used to describe the retail reaction, I see terms like panic, red, even backing up the truck.
Mm-hmm.
It seems designed for, high energy, to get a visceral reaction.
And there's a risk there, right? I mean, is there a risk that focusing so much on that high-energy emotive framing might actually undermine the financial logic?
Especially when you get to the more nuanced parts.
Exactly. The valuation arguments, the forward PE dropping to around 32, that's a sophisticated point that gets a little lost in the hype.
I see what you mean. The substance is incredible, but the presentation feels more like an urgent trading alert than a measured institutional review.
Precisely. And my suggestion is to shift the focus from hype to conviction.
Okay.
I mean, when the data is this powerful, you've got 62% year-over-year revenue growth, massive net income, you don't really need the sensationalism.
Let the numbers carry the weight.
Yes. Let that fundamental data do the persuading, rather than relying on descriptors that just create trading adrenaline.
But I wonder, if we strip out all of those action-oriented terms, like backing up the truck, do we lose some of that visceral energy?
That's a fair question.
I mean, you're trying to engage a portfolio manager who might be on the fence. How do you keep that sense of urgency without sounding, volatile?
It's a critical balancing act. We don't want to lose the urgency. We want to ground it in financial language that means the same thing, but with more gravitas.
Okay, so give me an example.
Well, for instance, instead of calling the drop in Section 1 a panic, maybe frame it as assessing short-term volatility, or even better, the consolidation event.
Oh, consolidation event is really powerful.
Right?
Because it implies an institutional phenomenon right away. Shares moving from weak hands to strong hands.
Exactly. It uses technical language to describe exactly what your thesis is, that smart money is buying. It aligns perfectly.
Okay, I like that.
And similarly, take a phrase like the moat. Demand outships supply well into 2026. It's aggressive.
A bit salesy, maybe.
A little. What if we shifted it to something more analytical, like supply-demand imbalance projections, the Blackwell supercycle, and extended order fulfillment timeframes?
I see. So the goal is to just let the technical details speak for themselves. The pros should match the confidence that the numbers already establish.
Exactly. These are just a few examples, of course. But these subtle shifts in tone will make sure it matches the gravity of the financial claims being made. It's a very serious, long-term valuation claim.
And the language needs to reflect that seriousness.
All the way through.
That's a great point. And if we clean up that packaging, the next place this report can really win is in, tightening the mechanics of the argument itself. Let's talk about the bridge between future earnings and today's price. As I read it, the argument is that the stock is cheaper today because of that low forward PE of around 32.
Correct.
But the detailed evidence for why those future earnings are so certain, the whole Blackwell cycle, that's presented way later in Section 3.
It feels disconnected.
Yeah, it feels almost like a separate supporting note, not the core pillar holding up the entire valuation.
The connection between the strong future fundamentals, specifically the Blackwell chip cycle and sustained demand, and the low forward PE needs to be explicitly strengthened within the valuation section itself.
So the report identifies the moat clearly?
Oh, absolutely. The Blackwell supercycle, demand exceeding supply until 2026. It's all there. But the critical link between that massive multi-year certainty and the calculation that makes the forward PE so low, it's implied. It's not mathematically or even qualitatively established right there in Section 2.
And that really drives the whole thesis home. I mean, if you're telling a skeptical analyst the current PE is almost 45 and the forward PE plummets to 32, they need to know exactly why that huge contraction is justified. If they don't see the direct, tangible link to Blackwell's revenue visibility, they might just think the consensus estimates are
overly optimistic.
Exactly. And conviction turns into speculation.
Right. We have to reduce that leap of faith for the reader. So the suggestion is to really bolster that valuation argument. Dedicate a segment to how the projected demand for Blackwell is factored into those estimates.
Show the work.
Show the work. Justify that aggressive drop from 44.81 to 32. Show the mechanics of the valuation contraction.
It is highly unusual for a company with that kind of growth, 62% year over year, to see its forward multiple shrink so steeply.
It is.
Unless the market has immense, almost physical certainty about future earnings, and that certainty is the moat.
That's it. You have to explicitly state that the moat is the engine driving the PE contraction.
So how do we do that?
Well, building on that, one really effective way would be to insert a bridging statement right in Section 2.
Okay.
Something like, this dramatic contraction in forward PE is directly underpinned by the anticipated non-cancelable revenue contribution from the proprietary Blackwell architecture.
I like non-cancelable.
Beyond the immediate fiscal year, it just de-risks the whole trajectory.
That phrasing is excellent. It connects an abstract financial metric, the PE, to a concrete physical reality, non-cancelable orders and supply chains.
Or you could take another approach. You could include an analytical note comparing the PE multiples of prior hardware cycles in the industry to this one.
For historical context.
Precisely. Reinforce why this moment is an anomaly. You have this high validated growth combined with a relatively low forward multiple.
That instantly tightens the whole argument. The valuation section becomes almost unassailable when the moat is explicitly named as the justification for the multiple dropping.
Absolutely. It ensures the sophistication of the analysis is seen and understood.
Okay, so that brings us to our third major opportunity, which I think is about completeness, about robustness. The analysis is so powerfully bullish. It focuses on internal strengths, technical support, but it sort of lacks the weight of a stress-tested conclusion.
I agree.
I mean, the material makes a really strong case for institutional buying. It highlights the 176 support floor, the consensus target of $200 plus. It explains why the big buyers are coming in.
Right. But a comprehensive analysis report requires robust stress testing. That means you have to identify and then proactively neutralize the most probable counterarguments.
And this one doesn't.
It focuses almost exclusively on internal strengths. It lacks a balanced perspective. It doesn't talk about any of the external risks that are, widely discussed.
You're talking about things like potential competition from hyperscalers, Amazon or Google building their own chips?
Exactly that. Or supply chain vulnerability, with global manufacturing concentration.
Or even regulatory shifts, anything that might impact market access or pricing power in, say, China.
Precisely those things. And by avoiding these known risks, the report creates an unnecessary blind spot. Your audience, that sophisticated investor, they're already thinking about this stuff. And when they see it's ignored, the report unintentionally signals that, hey, maybe this analysis didn't consider our perspective.
And you lose credibility.
Instantly, it just leaves room for a skeptical analyst to mentally raise these objections and not find any answers in the document.
So the suggestion is to add a section?
Exactly. A brief, high-impact section. Call it risk assessment or contingency considerations. Address the main challenges to the growth model, even if you just end up dismissing them.
So it demonstrates confidence. You're saying we've looked at the worst-case scenario and the bullish case still wins.
That's it. It shows the analysis is robust because it's considered opposing views. That's the hallmark of credible institutional research.
Okay, so let's get concrete. How could you address, say, skepticism about competition?
Well, you could add a focused paragraph, maybe title it, Countering the Competition Narrative.
Right.
And in it, you'd argue that the proprietary CUDA software ISPO system acts as a significant barrier to entry, mitigating risk from general-purpose chip developers.
Which is a strong defense. It moves the argument away from just raw hardware and into the software ecosystem, which is a much stickier moat.
Much harder for competitors to cross. Or you could tackle the global issues.
Okay.
Add a bit on the regulatory outlook. Assess the potential impact of geopolitical trade restrictions. But then you can note current diversification strategies or potential for regional manufacturing.
You address the risk head-on.
You address it head-on, even briefly, and it neutralizes that potential reader resistance. It elevates the document from a strong argument to a truly holistic piece of analysis.
It's amazing how much credibility you earn just by showing you've considered the bear case and have a confident answer for it.
It transforms the document.